you don't over leverage is that's when you pedal to the metal, purchase things. We pursue a direct operating model to build what we call strategically important companies. So our view is we do transactions where our capital is protected to the downside.
Thank you for joining us on this month's episode of the Third Thursday Themes webinar. I am so thrilled to have my friend David Capobianco here from 5 Point Energy to share his thoughts on what's happening in the energy markets. David, thank you for joining us.
Thanks, Mark. Appreciate being here and the time today.
Absolutely. So, for those who aren't familiar with your firm, can you give us an overview of what you guys are, what you do? I am personally excited to share this with our ecosystem because I think in the energy space, a lot of people know upstream energy. A lot of people know energy infrastructure and transition. But I think where you guys play is very unique and specifically with your focus and what you guys do. So I'd love our investors to learn from you.
Sure. Appreciate that, Mark. We are a firm that we founded in 2012. We are based in Houston, as you know. And today we have 5 investment vehicles that comprise over $8 billion of capital under management. We started the firm, and I say we, my partner, Matt Morrow, and I started the firm with the idea of being something very different. And when I say that, I mean different from traditional private equity. We decided we were going to change the paradigm in a really fundamental way. And rather than have finance people supported by operating people, we were going to be an operating company supported by finance people. Mm-hmm. And on the face of it, it sounds simple, but in practice, it's very, very different. Our employees are primarily ex-CEOs of energy and infrastructure companies, and we have very talented finance people who support them. So that enables us to have a different approach. What we do effectively is we pursue a direct operating model to build what we call strategically important companies. Mm-hmm. And our direct operating model entails 2 meaningful things. One, for 5 Point, we act as the executive CEO, chairman of every company. We do have CEOs and the full operating group, but we're very involved, more than the typical private equity where you just be involved in capital and strategic allocation decisions. We're involved in capital, strategic, operating, and commercial. But even more fundamentally than that, our main objective is that we seek to keep all of our IP at 5 Point at the core. Now, for instance, we may get to it, we may not, but we have a GIS platform that has accuracy down to a centimeter in every basin we operate in and enables us to have real-time information across the board on the basins, the water, the oil, the gas, the zones, the surface, you name it. We have instant, unlimited information, and all of our portfolio companies use it and make it better. And in the same way, we do that with our general counsel, works through every company as the general counsel, and we bring our best practices to every business. We have direct relationships with customers rather than letting our portfolio companies have those relationships. So that direct operating model with the combination of working hard to build strategic businesses, what that does for us is it enables us to be concentrated in our investment portfolio. Each fund will have only 3 to 4 companies, but these companies will have downside protection, they'll have upside protection, and will ultimately be leaders in their target theme.
Well, you just mentioned downside protection, and anybody who's been on one of these Third Thursday Themes webinars with us or seen a few of them knows that the first question beyond what's your background and what do you guys focus on is focusing on the downside. We have this saying that we like to talk about the downside. When we're comfortable with the downside, the upside takes care of itself. So as you're thinking through investing, and maybe use this as a way to highlight the unique types of assets that you guys invest into, and talk about how you think about the downside of a produced water system out in the Permian Basin.
So it's a great question, Mark, and we feel like since our inception, our downside protected approach has been really a core hallmark of what we do. So our view is we do transactions where our capital is protected to the downside. Full stop. We do that in a number of ways. One, we will have a price for the asset that is very attractive. Now, every other downside protection you can have, price is the most important. If you buy it at 5, you're way better off than if you buy it at 8. One. Two, we have long-term contracts with contractual obligations, including acreage dedications and minimum volume commitments. Really important. And the combination of those two will create a floor value of what that build out or purchase is going to create for us. And then the last and really important piece of our downside protection is the actual infrastructure that we're talking about. If it's a land deal, it's because we're buying land that has fundamental value. If we're building water systems, that pipeline in the ground cannot be replicated, won't be replicated, those right of ways and that connectivity, and there's fundamental value to that. So that creates, because we're talking about real assets, that creates a downside floor as well.
So, thinking about those ways that you protect the downside, what are the headwinds you're facing in the industry right now? I mean, what's happening? There's a ton of conversation around the regulatory environment right now. Some people think it's getting better. Some people think it's getting worse. What are the headwinds that the infrastructure space, particularly in the area that you focus, are facing?
So we pride ourselves on not having competitors and not being in a sector that others would talk about as well. We have very specific themes, and we can get into those. But within our very specific themes, we have very specific things that we seek to do. So headwinds right now, let's talk pre-tariff volatility and post-tariff volatility. Pre-tariff volatility, our themes are firing on all cylinders, 10 out of 10. We had a favorable administration for the build out of energy and infrastructure. We have a strong but not overly ebullient commodity market. We've got great secular trends behind everything we're doing. So say prior to tariff volatility, it was a 10 out of 10. Tariff volatility is a downside and a headwind for everybody. And mainly because it can create a economic slowdown of some magnitude. And you can have your own view of what are we talking about, a small downturn in major markets, or are we talking about a worldwide recession? And both of those are negative for not just our strategies, but all strategies. The one thing I would say, though, which is the beauty of our approach, is we lived through the pandemic. There is not a worldwide recession that can hit the energy markets like the pandemic did. Negative $36, $85 oil prices is a pretty tough way to make money when historically we model that wells completed and flowing will continue to flow because all the capital's already been in. And even though they have a $10 to $12 a barrel actual operating costs, even once they're developed, nobody ever thought about that. When you go to negative 36.85, we had 30+% of the whole Permian shutting in. So this is a new way of looking at the world. We feel very comfortable with our approach because we grew through the pandemic and we didn't lose any investment. So we feel really good about the environment. And we do, just as a quick note, if you're curious, we think we'll get past this tariff volatility and we'll return to a very favorable market. It's just a question of how long does it take to play out.
Sure. And thinking more positively, and maybe highlight Deep Blue here, one of your portfolio companies, because I think it's a really interesting partnership to the extent that you can talk about it with Diamondback. I think there's lots of reasons to be optimistic there. And so what are the trends that are pushing that opportunity set forward and specifically with Deep Blue?
Well, if you'd like to talk Deep Blue, we can quickly hit the downside there, which is really cool, and then hit those upsides if you like.
Yeah, that's great.
Bailey, put the downside slide up for Deep Blue. This was a transaction where we priced it at 5.5 times EBITDA. And again, getting to price, there's nothing better for downside protection than pricing it at a level that really works. We also had a view that we knew the customers, and like I said, 5 Point has these direct relationship with customers. So We knew the customers we were going to bring into this system. We knew the customers needed a solution, but they weren't going to jump on to an owner-operated system with Diamondback. So we had Ovintiv, Pioneer, SM, and Double Eagle already prepared to come into the deal. So the way we looked at this, and it takes a second to describe what this chart's showing, we looked at this as, okay, the pandemic is about as bad as anything can happen to our sector. So Diamondback's activity slowed from 305 completions to 189 completions in the pandemic. Interestingly, popped right back to 284 the very next year. But let's talk about that 189. With the business we knew we were going to add, we modeled the 189 level of completions for the whole life of our investment project. And in that scenario, we get fine returns. Nothing we're excited about, but we're in the 1.2x, 1.4x return. So we looked at that from a downside protection. Because of our acreage dedicated throughout their whole of the Midland Basin, we said we have a very strong downside protection for the capital we're deploying there. You asked about the upside, so flip over. Bailey, why don't you just show the Midland Basin, because pull up the Midland Basin in our this is our GIS platform I was referring to. So Bailey's going to zoom in on our GIS platform to the Midland Basin in brown there. And Bailey, put the box around the Midland Basin that shows you the core of the Midland Basin. The unique thing about this transaction, in addition to its downside protection, was that Diamondback's initial assets basically create a ring around the core. And that's what we love to do. If you can create a ring around the core, connect up the assets, add customers and fill-ins, and create a system that has more reliability, more fundamental services to provide to your customer, and a more attractive price. So Bailey, add the yellow is Diamondback's acreage, and the blue are the Diamondback pipes we bought. But add the new customers we've added there. Add the Lagoon transaction. And you can see a really unique building up of a great business. Now, we're literally able to get to just about every customer in the basin. And one of the major upsides here is there are a lot of what we call stranded drilling units. And a stranded drilling unit, it can be a Pioneer drilling unit that hangs off our system, but is not anywhere near their infrastructure. We call those stranded units. Bailey just put the stranded units in purple up there. We've been connecting up to those stranded units at like 2 times EBITDA on average.
Wow.
And that's another potentially. So prior to the stranded unit program, we've got about $180 million of EBITDA that we're in under 5 times average. Add the stranded DSU program, you're talking about another $150 to $200 million of EBITDA that we can get into at 2 or less.
Wow.
And then lastly, we had this upside of Diamondback buying Endeavor, and Bailey put the Endeavor assets in the Endeavor infrastructure. So we're in the process of negotiating a transaction for Endeavor that will really just make this an incredibly unique system with unparalleled capabilities throughout the core of the Midland Basin.
You know, one of the things I think is interesting about the energy space that not many investors who aren't in it understand is that it is a deeply physical business, right? And you're showing that here by all these different lines. And for those who maybe aren't following all of it, what this just shows is that if you are in these areas where there's drilling activity, that's a good thing. If you're not, that's not a good thing, right? And more so for a system like what 5 Point does with the Deep Blue water system, which effectively is the water that is either used for or used from the hydraulic fracturing that happens across all of these wells. So you're talking names like, the names you listed of Diamondback, which acquired Endeavor, Double Eagle. These are names we should be familiar with because we're investors in some of these names. they're doing a ton of drilling activity, and that drilling activity requires water, and then it produces water, and they have to do something with it. And that's what Deep Blue, the system that David has outlined, which I think, correct me wrong, is the red squiggly line, right? That if you can kind of follow it through, that runs north south. Yeah, that's a great. Thank you for highlighting it. That shows that that's right in the middle of all of this activity. And so just to put it real simply for folks, if you're in the middle of all of that and you can connect other people to those systems, you're going to get paid.
Well, I guess to put a finer point on that, Bailey, put up all the rigs working in the Midland Basin, and you can also put up the horizontal wells quickly, and we'll have to take it off because the chart will get pretty busy, but you can see how this is the core, and water is the critical. Moving water keeps the oil and gas flowing. You can truck oil, you can flare gas. If water stops flowing, oil and gas shuts in. So you can see that's why we are exactly covering the core.
Yep. All those, are they gray lines or brown lines, whatever the color they are, those are all the wells that have been drilled in the Permian, in the Midland Basin of the Permian. So Midland and Delaware are the two major basins, for those who don't know, inside of the greater Permian. Maybe shifting gears a little bit, everybody likes talking about data centers right now, and what's happening with the artificial intelligence boom. I was really struck when I attended your annual meeting last year about this partnership that you guys are forming in the technology space. And so maybe talk about this kind of ties with the question of what are people not appreciating about what's happening with data centers as a theme that you guys are focused on? What are you excited about in that space?
Okay, so first of all, we believe West Texas is full stop the best location to build out powered land solutions for data centers. Powered land is our newest theme, and a theme that is beginning in Fund 4 and will continue to Fund 5. It is basically the idea that we build powered campuses that enable the development of data centers. So Bailey's put up our locations on our surface, and your group may be aware, but we took a business called Landbridge public last June. It's been the best performing energy stock and number one on the NYSE since it came public. But it's a 280,000 acre business that's about $5.5 billion of enterprise value today. On that land, we have some unique attributes that make it particularly well suited for data centers. And we are focused on building out powered land campuses on our land. So a powered land campus will have, obviously, power. It will have a data center. It will need access to water and fiber and connectivity with utilities as well, and also connectivity with potential solutions like carbon sequestration. So Bailey is zooming into one of our locations, which is the Wolfbone Ranch. That's a Landbridge 50,000 acre ranch that we acquired 3 or 4 months ago today for Landbridge. The beauty of this location, and this is the power of our ecosystem, the beauty of the Wolfbone location is it sits adjacent to Waha. Waha is that green star. Waha is the hub for natural gas in this region. The beauty of Waha is that gas is free, and sometimes you get paid to take gas at Waha. For the last 6 months of last year, Waha gas price was negative 19 cents on average, when Henry Hub, which is the major hub of North America, was $3 or so. So it just puts it into context. You have the cheapest gas in the world in this basin. And the reason you have the cheapest gas in the world is because a lot of it gets flared and there's not enough takeaway capacity. People drill to get the oil. We deal with the water for them. They process whatever gas they can and flare the rest. So that's why gas in this area, particularly if it doesn't have a takeaway solution, is free, or sometimes they pay you to take it. So when you take free gas and you take gas-fired power generation, you will end up with the cheapest power in the world. Mm-hmm. Now, over time, this sorts itself out, but we will forever have a $1, $2, $3 discount to major hubs. So this is the cheapest place to build power in all of North America and possibly the world. That's one. Two, we have, and Bailey just put up all the red lines. That's the gas infrastructure that exists today. But two, we have phenomenal water infrastructure on our ranches. Put up all the water wells. We can deliver 1 million barrels a day of water in any one of our target locations. If you want to build a gigawatt data center, that's about 350,000 barrels of water a day. Imagine you're building just outside of Dallas and you reach out to the municipal water source and say, we'd like to take 350,000 barrels of water a day off your municipal source. The answer is no. So you end up having to air cool and use other approaches to cool, which are much, much more expensive. We have unlimited water at 20 to 30 cents a barrel. Particularly in our aquifers that are just slightly briny, we can use a reverse osmosis process and produce water suitable for the data centers at an extraordinarily low price, probably the lowest price also in North America. So that's your water and your power. We have unlimited land, obviously, for expansion. Then you take the carbon sequestration option. Carbon sequestration, we run, as you know, in Northwind, sulfur separation, carbon sequestration business in the Permian Basin. And we effectively will create an extension down into this area to be able to provide to the hyperscalers who want to build out data centers a solution that is effectively a net zero powered data center solution, which we think is attractive. And then another nuance, which is really cool, Bailey, show the salt underlying our Wolfbone Ranch. So this is getting a little bit technical, but we have the ability to build gas storage in the subsurface under our ranch, which will also be able to provide 5 nines reliability for the gas solution to the power plants and ultimately the data centers on our ranch. So we feel like, and we've spent a lot of time with Governor Abbott and Lieutenant Governor Patrick, we feel like West Texas is the best location and we have the best solution to be able to build out data centers. And they're strongly supportive of this objective.
Just to go down this path a little bit further, because I think it's very interesting. What has the response been from the hyperscalers, from the technology community? I mean, you kind of go up to Silicon Valley and you talk about West Texas, you talk about the Permian Basin. You know, what is their interest in this, and how do you see these things coming together into building, you know, the next effectively Northern Virginia area of data centers out in West Texas?
So we have to start using techie jargon.
Yeah, we do.
The fact that we're building in the desert is a feature, not a bug.
There you go.
That's the way we describe it to them. It's a feature, not a bug. They first say, well, why would we go in the desert? And what we say to them is because you can. You have no population centers. You have no one who's going to protest you. You talk about how long is it going to take us to get our right of ways. Our response is, do you want them by Tuesday or Thursday? So we've gone from, in our early conversations, them saying, bring up all these ideas. Well, where will the people come from? Well, it turns out there's probably $5 billion of construction a day going on out there. You know what I mean? There's a very well-worn approach to developing and building things there. And of course, you'd have to build more infrastructure places for people to live and ultimate support, which is part of our opportunity. But they've gone from the feature and bug conversation to now they're saying, we've got Texas overflow. We're all about Texas. We recognize Texas is going to be a giant play for data center build out. And just to put a finer point on it, Mark, everybody talks about Langley, Virginia, how awesome it is for data centers. It's got like 4.5 gigawatts of data centers. Bailey, just zoom into Saragossa itself. And this is one of our 7 locations. But in Saragossa itself, we've laid out the power, the data centers, a solar farm that's already permitted, and water connectivity for 10 gigawatts of data centers. This could
Wow.
very easily be the core of all of North America's data center build out.
I mean, well, what do you think? Let's talk headwinds then. What's preventing this from moving forward? What do you think are the challenges that need to be overcome?
Biggest challenge, full stop, is getting your power plant up and running. Turbines are on back order, and we're in the queue. We are trying to move ourselves up the queue, but that is full stop. If I had a gigawatt of turbines, we would begin construction on the first data center as we speak.
Mm-hmm.
The next challenge throughout the supply chain includes things like substations. There's also now a run on substation equipment, so that's out in the queue. Now, connectivity and air quality permits, those things are like anywhere, they're time consuming, but there's a well understood process and you'll get there. It's really all about delivering the power. And once you've delivered the power, we'll get the data centers. Now, I don't know how sophisticated the people who'll be watching this podcast are on specifics around AI, but AI needs a number of things. It needs training centers, which comprise large language model learning and testing. Then it needs inference, which involve actually utilizing the large language models. And then it needs cloud computing, which actually all the computers talk to each other and come up with real-time solutions. So all those things are possible in places like Langley because of all the compute that's already there, and now Atlanta with the building compute. Right now, the first build out will be a learning center for large language models. But if you follow it, as soon as we get past a gigawatt, 2 gigawatts, and 3 gigawatts, our locations will be more than suitable for inference. Mm-hmm. And ultimately, at 4 gigawatts, we're as good of a cloud computing location as anywhere.
Yep.
So it's literally just educating people who are drinking out of a fire hose in the hyperscalers about why West Texas is the best long-term solution.
Sounds like you're the man for the job. Maybe moving towards a bit of a conclusion here, a couple questions left. The first is, we like to use a 7-point scale at our firm, 1 to 7, 1 being the worst, 7 being the best. And we think about these things on a relative risk-adjusted basis of, okay, given your history in this space and the number of things you've seen in the different cycles, what's the sentiment at 5-point right now, 1 to 7 of the investments that you guys are focused on, the environment, all of the things together? And be honest here, right? Like people try to lean in with a 6 or a 7. I think that's going to change something in the world. It may not. But how do you guys feel waking up every day in the current environment? Where are we? 1 to 7. Worst to best.
All right, again, Mark, I'm going to answer on a pre-tariff and then add the tariff program in it.
Yeah.
On a 1 to 7 coming into this year, we have 5-point believe we were a 10. We've never seen an environment like this ever. Our last 3 funds are all over 50% IRRs, so we don't compete for transactions. They come to us, and we choose the ones we want to do, and we negotiate them the way we want to negotiate them. So we really are firing on all cylinders pre-tariffs. Tariffs create some challenges and opportunities. I would say on the challenges side, you could for sure see a slowdown. 100% you could see a slowdown, and that will bring that 10 down into the range, 6, 5, 6, 7, depending on how negative the economic impact is. But the beauty of times like that, if you're prudent and you don't over leverage, is that's when you pedal to the metal, purchase things. And purchasing during those times, like, the 3 funds since the pandemic are all top decile and number 1 in their category because we were leaders going into the pandemic, and rather than hide under rocks because we're over leveraged and worried about losing portfolio companies, we were pedal to the metal. and it's really served us well. So we're cautious, and because of this tariff program, I'm supportive of it. By the way, I think it's the right thing and it's a necessary thing to do. But it would be naive to think that it doesn't have potential economic implications.
Thank you very much for taking some time to speak with our investors today. I really enjoyed it myself. We're very grateful for the partnership here and look forward to growing it in the future. Thank you, my friend.
Sure. Thank you, Mark. I appreciate your support.